All right, Josh, we're live. We're ready to go.
All right. Well, welcome everybody officially. For those of you who are here live, people have been tuning in here over the last few minutes. Thanks for joining us. And also for those of you who are watching the recorded version of this, of course, welcome. And thanks for giving up some of your time. Certainly these days, there's no shortage of information out there and videos and things all over the place. So thanks for giving us your attention today. We will make it worth your while. I promise you that, as we've got some interesting stuff to talk about today. Certainly the last couple of years have been just chock full of things to talk about, right? As far as news events and things going on in the world, the economy, the market. So we're going to catch you up on kind of what we're thinking and what the experts are thinking today. A couple of things that I did want to mention is the best way to get information out in our world to people is by people that know people. In other words, almost all of our clients, I mean, really 99%, I think, plus of our clients end up joining us because somebody knows somebody. In other words, they introduce somebody to us, whether it's a coworker or a family member or just a friend, somebody who needs help. And all of you have been very, very kind of telling people about us. And of course, sometimes it takes them a while. It's interesting. Sometimes when people join us as a client, they say, you know what, so-and-so has been telling me about you for the last 10 years. And finally, I'm coming in. So you never know, when you're planting seeds like that in people's minds, we just want to be here of service. We want to help people. We want to add value to your life, but also the people you care about. And in our world, in the financial planning world, traditionally, it really was more of a sales world. If you look over the last several decades, it was mostly product salespeople really trying to sell, insurance products or things like that, get paid commissions. Our world really at Keystone is a comprehensive financial planning world, meaning that we're looking at everything in the client situation. And you've got the benefit of us being fee only. I think that's a benefit simply because, there's conflicts of interest in any kind of a relationship, whether it's your physician or anybody you're working with. But from a fee only standpoint, one benefit of that is that we don't get paid based on the products that we recommend. The only way we get paid is by our clients, really. So you've got the benefit of knowing that really we're on the same side of the table as you are when we're recommending, one move or the other. That really is our job, is to be your fiduciary, to be acting in your best interest. So that's really what Keystone is about. And I think our focus is really on relationships. And certainly there's a lot of substance that we need to talk about, tax code and the state laws and so forth. And ultimately, we care about your life. We care about what's going on in your life and what's important to you. And ultimately, that's what it's about. When people are at the end of their life, that's all they really care about, right? Is their memories and their relationships. And they don't really care about their career and their money and things like that. So our job is to make sure that we can not just make sure that your financial planning is taken care of, but that it ends up resulting in a better quality of life, that you really are in a better position to enjoy your life. And so we want to make sure that that gets, certainly applied to all of our existing clients, but also anybody new that joins us. As far as Keystone, we've actually had a great year. Last year was our best year ever, from a growth standpoint. This year, I think we'll top that for sure. And that is a result primarily of people referring people. We've gotten a lot of referrals this summer as well. So thank you so much for introducing, again, people that you know, and for sharing this information to people that would find it useful. Again, our job is just to add value. And, if that results in a client relationship, that's awesome. So a couple of things just to update on the team. We've definitely grown from a team standpoint. We've added several virtual employees over the last year. Many benefits. There's been many blessings of COVID, and we'll talk about that in a bit. But one of those is just the fact that the way that we've worked has changed. And it also has allowed Keystone to find some great people that we probably wouldn't have met before. So definitely wanted just to let you know that we are always interested in hiring in advance, making sure that we've got the staff to be able to handle not only your stuff, but also new clients coming in. We want to make sure that we're very robust about our hiring and that we're hiring great people. As far as our mission, again, really it comes down to building relationships and bridging that gap between knowing and doing in the lives of our clients. And what I mean by that is that there's no shortage of information out there, right? There's all kinds of videos and things online. There's too much. I think that's actually one benefit to us as a business, is that there's too much information and people don't know what to do with it and how to actually put it into a plan. So that's our job really as financial planners. And I talk about Jeremy and I being certified financial financial planners, we're really not only educated, but we've got the experience to be able to run through about any scenario, whether you're, ultra wealthy or you're just starting now. We want to make sure that we are able to help you, give you some value, and help you do your planning. So with that in mind, again, this is about relationships, and it's about also educating you. Over my career, I think I'm coming up on 21 years, something like that, 22 years, maybe right now, as far as a financial advisor. Yeah, I started in 99, so this would be 22 years, right? Yeah. So over that period of time, it's just been about relationships and educating clients and really putting a lot of focus on financial education. That's been a key thing that we want to make sure that we're keeping up on, is not just telling you what to do, but also educating you, helping you understand how the financial world works so you can make better educated decisions. Our job is never to make your decisions for you. In other words, we can advise you and walk alongside you, but we want to make sure that you're educated and making sure that you understand kind of what you're doing as well, what the plan is and why it's put into place. So also the world around you, because of all the competing voices and the media and so forth, that's one big value of doing this halftime report and also our forecast presentation, which will be coming up in January, because we try to get past the noise. We try to get past the politics and the noise and all the garbage out there that, is just hard to wade through. It's hard to understand really what should I be paying attention to and what's true and what's not true. So I think this will be a great presentation today. Again, thanks for joining us. Of course, we need to tell you that everything we talk about is more or less just our opinions, from Jeremy and I. We can't guarantee anything. Obviously, when it comes to the stock market, to investing in general, there's risk associated with that. I think for anybody who's been invested in anything, whether it's real estate or stocks or bonds or anything like that, you know that nothing's guaranteed. When you invest in it, it's going to have some risk associated with it. So keep that in mind. So we like to warm up our brains. We'll do that in just a second, but more or less the format doesn't change a whole lot. For those of you who have been participating in our halftime and our forecast presentations over the years, you know that we talk about three things. It's broken into three sections, and that's where we've been, where we are now, and where we may be going. That's where we talk about some of the experts, kind of trying to read the tea leaves a little bit, right? The reality is nobody knows where we're going, but where we may be going, right? Making some educated, guesses, some thoughts that, would be thoughtful as far as how you might be allocating your portfolio. But before we do that, we always like to warm your brain up with a quiz. So in the light of everything reopening, and that's really the theme for today is the reopening, excuse me. So on Broadway, I don't know how many of you have been to Broadway, but it's pretty impressive. It wasn't so impressive here, a year ago with everything shut down, all the shows, everything were shut down, but everything is kind of reopening at this point. It's pretty impressive. If you have an opportunity to go there, it's pretty fantastic. But on Broadway, the rows of seats in the theaters, in other words, are designated using letters of the alphabet. So which letter is not included? So this is the audience participation portion of the presentation. For those of you who have located your chat feature or questions feature, let's see what people think.
Yep, we got a couple that are saying I.
A couple eyes.
Yep.
Yeah, maybe some experienced theater goers.
I think we might have, yes.
Yeah. All right. Any other guesses in there?
Everybody says I so far.
Yeah, that's actually a pretty darn good guess, because ticket buyers mistook the I for the number one. Who knows how far this went back, but they figured this out, that people would show up with their tickets thinking that they were in the first row, and that didn't go over so well. That probably resulted in some squabbles. So they basically just got rid of that, right? It's like how hotels got rid of the 13th floor, right? So which Broadway show has been the biggest moneymaker of all time? So would it be Mamma Mia, Wicked, The Lion King, or Cats? Which show would have been the greatest moneymaker of all time? Any guesses on that?
We have a couple for Cats.
Couple Cats. Yeah, that ran for a long time. I think it finally did end, right? A couple years ago.
Couple for Lion King as well.
Lion King. Yeah. Any Wickeds or Mamma Mias?
No Wickeds or Mamma Mias.
All right. Well, everybody who said Lion King was correct. And I actually have seen that show on Broadway, and it's pretty amazing. So yeah, if anybody gets a chance to go to New York, it's kind of a once in a lifetime experience, maybe more than once in a lifetime, but yeah, it's pretty amazing. Very, very talented people. involved. So, yeah, at $1.4 billion. That's crazy. Yeah, averages $2 million per week. Of course, during your non-COVID times, this last couple of years has been pretty rough, but 8 shows a week on average. Again, pretty talented people and very hardworking people that work on that stuff. So, ultimately, there are 41 Broadway theaters. How many are on Broadway Street? Many people don't know this, that all the theaters are not on Broadway. Broadway is just the generic term, right, for the major theaters, but there are 41 theaters in New York City. How many are on Broadway Street?
Me personally, I did not know that there were 41 Broadway theaters.
I did not either. I knew there were a lot, and I also knew they weren't all on Broadway, but I didn't know the actual quantity. So,
yeah. So we have a couple for 19. We have one that says 4.
all right. Well, hopefully you guys aren't Googling this. That's not fair. But actually 4. Yeah, 4 is the answer. So yeah, and to qualify as a Broadway theater, you actually have to have a venue with 500 or more seats, and it has to be in New York City. So it's basically in that vicinity, but it may not actually be on Broadway. There's only 4 of those. So yeah, again, pretty cool experience. So let's talk about where we've been. And again, kind of the theme for today is the great reopening. And I think a lot of us have felt that. In fact, our family went back to Iowa and Minnesota here a couple of weeks ago, and we saw a lot of family that we hadn't seen since before COVID hit. And I know from talking to a lot of our clients, a lot of you are doing the same thing. A lot of you are going out and seeing family, friends, traveling. There's a lot of people on the roads. I can tell you from personal experience, Jeremy was just at the Great Ozarks, also family reunion. So yeah, pretty amazing stuff as far as kind of how things have opened back up. A lot of that I think is just confidence in, and maybe people are not feeling as fearful. In other words, ultimately, I think that's the big reason for that. But really, this first half of the year is what we're talking about. And that really is the great reopening. There was a big game changer here a few months ago. And certainly vaccines were the key to that happening. When vaccines came out, of course, they kind of came out in fits and starts, and it was a little bit of a bottleneck at the beginning, I think, for people that wanted to be vaccinated. And since then, it's been pretty steady. I don't think it's a problem anymore, for somebody who wants to get vaccinated, at least in the United States. And we'll talk about that a little bit internationally later on. But vaccines were the key to reopening, and it's been pretty steady. Really, the numbers continue to go up there. And ultimately, that is what resulted in this curve. You can see the chart on the right, and the chart on the left is the one that probably is interesting to look at first. The United States, China, there are other countries that are pretty heavily vaccinated at this point compared to the rest of the world. But really look at it globally. There's a lot of countries that are still struggling, especially emerging markets or frontier markets, we call them. Sometimes called the third world. I don't think it's called that anymore, but these would be more of your developing economies. Certainly, they don't have the same supply chains, delivery systems to be able to get vaccines out. So you can see that there are a lot of countries that are still struggling to get supply and then to actually get those vaccines administered. So the graph on the right, that is a 7-day rolling average of new confirmed COVID-19 cases. And so what we've shown you here is kind of the trend. And since COVID started, which loosely we're going to kind of put that at March 1st, 2020, I know it actually was a thing earlier on than that. And in fact, our son, he's 16 now, but our son, we're pretty sure that he had it before anybody knew that it was a thing, because we kept taking him back to the doctor and they said, yeah, we've tested him for all these viruses and he's testing negative to all of them. And, still had symptoms. Well, that probably was COVID. There probably was a lot of that going on well before March 1st. So 7-day rolling average, you can see that really, the spring, things were a little bit tough there. Everybody was scared. I don't think we knew a lot about what was going on. We had no visibility as far as any kind of vaccine that would be available. And nobody really knew how bad it was from a transmissibility, right? As far as how easy was it to catch. Now, we had a big spike at the end of last year, earlier this year, huge spike, in fact. And then the big game changer again was the vaccine being rolled out. And, of course, that continues to go maybe at a smaller pace, but ultimately the numbers have gone way, way down. Now, of course, the other thing that you could say here as well, that's just confirmed COVID-19 cases. Were there probably a lot more than this? Well, yeah, of course, there are a lot of people that probably had it, never knew it, or they had it and they never got tested. They could have had a little cold. It's the weird thing about this virus is that it kind of expresses itself in lots of different ways. So it's a big game changer. In other words, clearly with the vaccine getting out there, and that's going to continue to be a thing for years to come, certainly with some of these emerging markets. So ultimately, that did result in some good stock market performance. That was a big game changer for sure. Is having the confirmation that the vaccine was available. That actually happened last year. But looking at year to date, at least through June 30th, markets in general, stock markets in general, have done quite well. A little bit of smaller numbers in some of the emerging countries, Asian countries, but you look at the U.S. if you're heavily invested in the U.S., which most of you are. And then just looking at overall global markets, about 12.2%. So if you are very globally diversified and had your money spread out all over the world, about 12.2. If you had it all in the US, 14.1. So it's interesting to look at diversification and looking at it lots of different ways, because you're looking at it here geographically. But then on the next slide, you'll see that we oftentimes show people in this little grid format, different types of stocks from a size standpoint, big companies like Amazon, or little companies, smaller airlines, hotel chains, things like that would be considered more small companies, still in the billions of dollars, but relatively speaking. And then also value, core, and growth. Vaccine day, which really was last November 9th. In fact, you can see that there was a big shift. In fact, last year, through the first half of the year, really the first 3 quarters of the year, the stock market did good in general, but really it was quite focused on a small number of companies, mostly on the growth side of the equation. And if you want to know what is a growth company, well, a lot of them are tech stocks. A lot of them are the big tech stocks that we know. So a lot of that was concentrated up in that large cap growth area. In fact, we were even starting to get questions from people, from clients that, gosh, does it make sense to be diversified? This is last year, right? Does it make sense to be diversified, or should we kind of concentrate and put all the money in tech stocks or large cap growth? And of course, that as financial planners, that about makes our head explode, when somebody says that, but that's our job, is to kind of calm people down and say, no, there's a reason why we diversify. And I think this chart kind of shows you that through November 9th through June 30th, it actually flipped completely away from large cap growth stocks. So had you made that move, in other words, had you said, you know what, I'm not going to diversify, I'm just going to put it all in these large cap growth companies, you would be really disappointed, because you would have missed out on some huge growth in some of the other areas. On the value area, especially small cap value, would have been the big beneficiary recently. Now, the answer is everything. You want to do both. Should we have value or should we have growth? Both. You want to have both. Should we put it in small or mid or large? All of them. You want to make sure you're diversified. So as financial advisors, that is part of our job, is to make sure that you're disciplined in your investment strategy. So ultimately, companies have gotten a lot healthier. The quote here you can see shows that the vast majority of companies have resumed their dividends, increased their dividends, at least off of nothing. Many had stopped completely and suspended their dividends and now have resumed for a large extent. There's some sectors certainly that are struggling a bit. If you're a cruise line, you're not doing so great right now, other than the fact that they're getting some pre-bookings for cruises that will be happening next year. Not a lot of activity there right now. And ultimately, dividends are just a sign of earnings. You can't pay dividends if you don't have earnings. Dividends are just excess earnings that they're able to pay out to their investors. So ultimately, when you receive a dividend, you're actually receiving part of the company's earnings that you're invested in. So earnings growth has been fantastic. Looking at the first quarter, earnings growth was about double basically what was expected. So up 53%. Only 23.7 growth was expected. So big surprise there. That's a good thing. Certainly, it says the companies are very, very profitable and, above what was estimated. So that's pretty important, because it's showing that companies are actually very healthy right now. Now, maybe some other areas of the economy, there might be other numbers that we're concerned about that could be not so healthy, but ultimately company balance sheets by and large are quite good right now. Any challenges they have are probably more with trying to find workers, for example, or supply chains. Looking at stimulus, and again, we'll talk about this more in a bit, but looking at fiscal stimulus for over $5 trillion that was pumped into the economy over the past year or so, basically from COVID relief. It all kind of ties back to COVID relief. And we're not going to get political today. I know some people would debate and say, well, what could this bill, what does that have to do with COVID? We're not going to get into that. As financial planners, our job is to kind of be Switzerland, right? To be kind of neutral on that and just kind of look at things for the way they are. If legislation passes, then we kind of adjust, right? We're looking at it and how it's going to impact our clients. We don't get really excited about getting into the political aspect of it. So just keeping in mind, though, that $5 trillion number, that's a big chunk of money to pump into the economy very quickly. And, certainly there's more on deck right now as far as spending. Could that cause an inflation problem? Absolutely. That's a lot of the debate right now is, we're seeing this spike in inflation that we haven't seen probably since the late 70s, early 80s. Is that a result of government printing money and borrowing a bunch of money? Yeah, it is. So we'll talk about that in a bit. So treasury markets reflected uncertainty. The treasury markets, people I think of treasury bonds as, well, that's a safe investment. That's one of the safest places you could put money. But the reality is that interest rates and bond prices can fluctuate just like stocks do. They don't tend to, not as much, right? And they're not moving the same way. But when the treasury markets are, when you're seeing these rates go up and down like crazy, you're not seeing the Federal Reserve change those rates. So just to be clear, there's kind of two different rates. There's the federal funds rate, which is the short-term rate, and that is the rate that the Federal Reserve has direct control over. That's basically zero, and it's been zero since COVID hit. But they don't really have direct control over the bond market. In other words, longer-term maturities on bonds is determined by investors, and that would be in bond investors. So when you're seeing volatility, it could be just a lack of uncertainty about inflation. It could be lack of uncertainty, or actually the reality of uncertainty of people's kind of views on the economy, and also what the Federal Reserve might do in the future as far as rate increases or tightening things up. So ultimately, uncertainty will cause volatility in any kind of market, whether it's real estate, stocks, bonds. Just recognize that uncertainty does breed volatility. Home sales, I know that's probably on everybody's mind right now. The shortage of housing, the fact that we're seeing our house values go up like crazy. So you can see that the sale prices have gone up dramatically over the last year. Some of that is a result of inflation, of course. It's a sign of inflation, is that the price of housing has gone up quite a bit, as you can see. So medium sales price now is $350,000 in the US, at least right now. And the existing home sales have gone up quite a bit, increases in price, 23.6%. So some areas way more than that, depends on where you live, but ultimately people are seeing some big increases. It might make you feel good that your home price is going up in value, but recognize that some of that is just a result of inflation, really as far as money printing, not necessarily because your house is, done fantastically well because you did new landscaping or something like that. And then 5 cities saw populations decline, and that was as a result of a couple of things. Part of it's unrest. There was a lot of unrest last year, huge increase in crime. Some people have just been kind of hightailing it out of urban areas, going to smaller communities. But the other thing is that it was possible for most people's jobs, they could be remote. Right. And a lot of people still are remote. They could be interacting with their boss and their team via Zoom or other technologies. And a lot of people did. For people I know that live up in the mountains, up in Breckenridge and Copper, some of those areas up there, they said that, when COVID hit, that area got packed, just jam packed, because everybody that had a condo or a home up there, maybe it was their second home and they lived in New York or Philadelphia, something like that. They all wanted to get out of the city and go someplace else because they could do their job remotely and do it from maybe someplace more fun. So ultimately, we did see urban areas take a hit. That is starting to rebound. We are starting to see that turn, and we're starting to see employers actually require, in a lot of cases, or have a plan to have their people come back to the office, at least on a part-time basis. So with that being said, now we're going to talk about where we are.
Absolutely. So, just like with all the people moving, yeah, some people, I get the niceties of being able to work remotely from wherever they are. Of course, a lot of the times, if you've ever done a big move or anything, especially out of state, one of the things that comes with moving is a new job. And with new jobs come new job interviews. And so kind of a little brain break here is, if you've ever gone to an interview, I'm sure you've all seen some crazy interview questions. And Josh, if you can change the slide there for me. some of the fun ones that we've seen, or what's your go-to karaoke song, or if your boss asked you to lie. My personal favorite was actually courtesy of none other than our very own Josh Nelson on my interview day, where we talked about pirates and splitting up pirate treasure and whatnot. And I remember thinking, is this related to financial advising, or is this just kind of a fun thing? But, it's always just kind
Keep
of a
people on
fun
their
thing to see
toes.
what you've done. Absolutely. But where we find ourselves economically, always we use kind of that measure of GDP, right? Gross domestic product, as just the overall measure. And really what it says is, this chart says the same thing in basically a couple different ways. The blue line is in billions of dollars, and the orange line is in terms of percentage. But really what it's saying, if you look at a couple of things, the shaded areas on there, the two grays on the left and the yellow on the right, those are our most recent recessions. And so you can see a big gap between the, say, 2008, 2009 recession and the current one. And now this slide actually says the end date for this recession is actually undetermined, but has, as of, within the last couple of days, I think they've actually released the date and said, yeah, we're out of it, and we're moving on. So you can see a very long time period there of just some pretty steady growth, to tell you the truth. And then, obviously a pretty short recession from what we've seen, and now right back into the growth part of it. And so, long time between those, relatively short, but honestly, this recovery does still have some hitches. And one of those hitches that we see is through unemployment. And so as we can see unemployment as beginning to drop, at the worst of this recession, it was up around 14.8% was our unemployment rate here in the country. That is now somewhere around 5.8%, which is obviously a lot better than it was. Pre-recession, we were actually somewhere hovering around sub fours, like 3.5%. But we're at that 5.8% now and trying to get below that, but it's starting to kind of flatten out. And the question is why, right? Why is that happening? Well, it's not just one thing. It's a number of things. Some people are afraid to go back to work because of pandemic fears. Another big one that we see, especially in the media, is, unemployment benefits being too generous. Some people still need to be at home. Maybe they have kids, or a lot of people we found have just, reconsidered their career. This whole thing past 16 to 18 months has really just thrown a spin on their whole career and say, is this really something that I want to be doing for the rest of my life? Regardless, it's the combination of these things that has really created a tough environment for employers. And so what we see is employers, this is forcing businesses to kind of adapt to how they would do business. I know when this happened, we kind of changed up our business model a little bit just because, we had to. Luckily, technology was there to help us out. And a lot of other businesses have been taking advantage of technology to help them keep up with demand. But what we really see is, even though this employment thing is happening, that demand is very real, and quite honestly, spending is happening. And so
What I was going to throw in there, Jeremy, too, is that, just anecdotally, and I'm sure you're all finding the same things just as you talk to small business owners, especially, and big businesses as well. But as you talk to small business owners, is that's one of the most common problems that they're having right now, is that they can't find people. They literally can't hire enough workers, and that's starting to hurt their bottom line. Now, is all this bad necessarily? Not necessarily. There's a lot of things that can kind of get shaken up, when it comes to something bad happening. Well, sometimes it forces creativity. It forces business to rethink their business models, and sometimes they have to get more competitive, right? And it also, I think it's a great thing, just personally, because as financial planners, we talk to so many people, Jeremy and I both do, that they love their jobs, they love their careers. But we talk to some people that hate what they do. I mean, they really hate it. They feel like they've got golden handcuffs. And so, they can't leave the company they're with or the job that they're in. So I think it's fantastic when we've got an environment like this where there are so many jobs available. Competition's a good thing. I think competition actually ends up solving a lot of problems.
Absolutely. Yep. And so that's kind of where we find ourselves right now. And along with that, though, is you would think, well, employment's still at 5.8%. What's happening out there. But honestly, what we saw is initially, when the pandemic started, is everybody went into save mode. And so we saw a lot of saving. Saving was going through the roof. Bank balances were going up, which honestly kind of exacerbated the situation for a lot of businesses, right? Nobody was wanting to spend their money. That didn't last very long. That actually had a pretty quick turnaround. And so people started spending money because they were stuck at home. They needed to do something. They started buying projects, things of that nature. So we saw initially the spending, but it was very, I would say, sector specific. All right. There was certain companies, travel companies, cruise lines, airlines who were really having a rough time because nobody wanted to travel or couldn't travel. But now we're starting to see that really spread out among the various sectors. And so things, certain areas like travel and tourism, they're still kind of having a longer route towards recovery, but still starting to do better. But if we think about it, really, all this says is that the laws of economics do prevail. And it comes down to supply and demand, which is a big thing that's happening now, is that obviously supply chains are hurting right now. There's a lot of things. If anybody's tried to buy a car recently, or my wife and I recently replaced our cell phones. And I don't know why this didn't occur to me before we walked into the store, but we walked in, walked into the Verizon store and said, hey, we're looking at replacing our phones. And they say, great, we have 2 phones that are available and you can pick this model or you can pick that model. And we said, you got to be kidding me. And ended up, we tried to replace our 2 phones and then get a replacement for my daughter's phone that broke. And we ended up going to 4 stores to find 3 phones. Just a reality. And they just said, yeah, it's the chips and whatnot. And so really, if we look at supply and demand, anybody who's, taken even just a basic economics course knows that if the supply is low and the demand is still there, prices are going to increase, right? And ultimately, when prices increase, this tends to start to lead to a lot of concerns about a big thing on everybody's mind right now, which is inflation, right? And so obviously, inflation is a thing. Inflation is real. And what we're seeing is that it is expanding a little bit quicker than everybody's expecting. Of course, for a very long time, our inflation rate has been very, very low and interest rates have been very, very low. I remember Josh said, I was out having, a family reunion and helping my parents celebrate their 50th anniversary here just this last week. It came up in conversation, mortgage rates. We all own our own houses, and my parents told me the house that I grew up in, they had a starting mortgage rate of 13.5% on that house. And that just blows my mind. I personally cannot think of that in my lifetime of buying houses. I've never been at a point where I would even consider paying that for a mortgage, but it was reality, right? It was in the, beginning of the 80s, mid 80s that all that was happening. And so it's just a reality. But the thing going on now is lots of talk between the Fed and various companies saying, is inflation right now, is this more of a transitory thing where, it's more relatable to the supply chain breakdowns? Or is this more of a bigger long-term thing that's going to have its effect? And, we could argue this back and forth. It may actually be a little bit of time before we really know for sure, because anybody in the business industry, I'm sure plenty of people listening to this know that supply chains do not recover overnight. This is something that has to take time to build back up. and get back to where it is. Now, the Fed is taking a pretty solid stance on the fact that they believe it is transitory. And so they're not really making any moves for now, but that is also something that we're going to be keeping a very close eye on for the remainder of the year and kind of moving forward to see what the Fed does, and to also kind of build in a lot of that inflation hedging kind of moving forward.
Yeah, and it's kind of spooked the markets a bit recently. It's caused some volatility with fear about inflation. And just to pause for a second, what is inflation is just prices rising, and you don't want deflation either. Deflation is really bad. It's been very rare historically that we've had deflation. That means that prices are actually going down. The only reason for that to happen on an ongoing basis is that your economy is really in the tank. So yeah, you definitely don't want that. Some inflation is actually good because it's a sign of a rising economy, growing economy, but you don't want it to get out of control because it really can be bad, especially if you end up with stagflation, which is what was experienced. For those of you who remember the 70s, I think Jeremy and I were barely born at that time, but we do hear a lot of you talking about, and certainly we know history told us about stagflation, which means that inflation is actually rising faster than wage growth. It's rising faster than the growth of the economy. That's really not an environment you want to get into. And so if you're wondering, well, why is the Fed so concerned, or why might they have to act, is that if inflation is really starting to get out of control and rising above those things, then that can cause a real problem economically. And of course, at the end, early 80s, that did get remedied by raising interest rates very aggressively. And that's part of the showstopper for a lot of economic expansions, right? Is the Fed ends up stepping in, raises interest rates. It kills inflation, but it also kills the economy for a bit, right? It ends up causing a recession, and then on we go again.
Absolutely. And so, the fact remains, though, is despite rising prices and inflation concerns, so far for this year, investors remain pretty bullish on the market. We see trends that obviously it kind of swings up and down, and that's why we have volatility, is just those short-term swings. But overall, the market seems to be taking everything in stride, and we can see that through company earnings. I know Josh had spoken about company earnings through Q1 and 2. So far for Q3, earnings are still being released, and a lot of companies, especially major tech companies, Microsoft just recently released them, throwing out that they did much better than they were expecting to do from an earnings standpoint. And so the market's going to love that, and they're going to run with that as much as they can. But overall, I think really the idea is that, yeah, we have things to be keeping an eye on. We always do. But that's just kind of to give you some idea of, inflation is definitely a concern that we'll keep an eye on, and making sure that you're continuing to be divested among pretty much a little bit of everything, right, all around the world, because that's how we maintain that long-term outlook.
Yeah, and that's really well said, because we do pay attention to a lot of different data points when it comes to the health of the economy, the direction of the markets, and so forth. We pay attention to a lot of different data points. In other words, there's not just like one thing you can look at. In other words, that's going to predict everything. It's kind of three-dimensional. You've got to look at things a lot of different ways. But ultimately, yeah, that bull bear thing, it matters. How good do people feel about their pocketbook, or they're spending money? As Jeremy mentioned before, that oftentimes is what causes recessions. And it did very quickly last year, because basically everybody got scared like that. And when people get scared, they don't spend money. They tend to hoard money and save it. And is it a good thing personally to be saving money? Well, of course, but it's not good for the economy, right? It's not good for people not buying products and services. That's going to cause a recession. So ultimately, this is just one of those data points. So let's talk about where we may be going. This is always the fun part. This is probably what you've been waiting for, right? Is what's the prediction? What's going to happen? And I think the truth is we don't know, right? We always want to be looking at all these data points and be thoughtful about it, and also be paying attention to what different, experts are telling us. So this is just a kind of a fun quote from Malcolm Gladwell. I'm sure a lot of you have read his books and articles. He's actually one of my favorite authors. He's really interesting to kind of get his thoughts. But yeah, recently he said, if every car on the road is autonomous, if every car is perfectly behaved, autonomous vehicles are rational and patient and good-natured in a way that human drivers are not. It means that pedestrians, cyclists, runners, little kids playing soccer can all do whatever they want. They can take back the road. If every car on the road is autonomous, pedestrians aren't terrified anymore. In other words, the cars are perfect. And the reality is that's kind of what they're seeing, with these Google cars and Apple cars and, the ones that they've been testing, is that the overall accident rate is dramatically lower than when humans are in charge of the vehicles. So, it's kind of a fun quote, but it's also reality, is that when we kind of look forward 5-10 years down the road, and some of it's happening right now, but when we look 5-10 years down the road, the semis, when we were driving back to, again, across the Midwest, it's all kinds of semis. 5-10 years from right now, those semis probably won't have a driver in them, or the driver, if there is somebody in there, they're just monitoring things and they're not actually driving the vehicle. I think that's going to be the reality for a lot of us too. And in fact, the insurance industry is really, really worried about this. The car insurance industry is really spooked about this whole thing because they make money by charging us premiums, right, on our insurance policies based on the odds, based on all the odds of people getting into accidents. Well, if those odds go way, way down because cars are automated, then they're not going to be able to charge us as much in premiums. The risk that they're insuring really will go away to a large extent. So in fact, some are predicting that you'll actually have, not only will that happen where you'll have the self-driving feature on the vehicle, but if you as the driver want to take charge, then your insurance company will know. This is a little bit spooky, but your insurance company will know, and they'll charge you higher premiums depending on how much you're in charge versus your vehicles in charge. So kind of crazy. But I think the whole reality, though, is that so much of so many problems, so many things that end up really driving economic growth are based on technology. And so many of our clients are involved in the technology industry. And really, a lot of the problems that we've seen because of COVID, a lot of those ended up getting solved by technology. So ultimately, kind of looking at kind of where everything is going. So the conference board, this is earlier this year, the conference board, which is a nonpartisan board that basically is kind of estimating based off of all the economic data points, where do they see things going? So economic growth for 2021, meaning the whole year, meaning that we won't know this until next year, but the base case that they ran was 6.6%. And that's pretty good. Historically, the economy in the US has grown by about 3% per year if you look at the last 100 years or so. So 6.6 is pretty darn good. That's above average. Now, their worst case scenario came out at 5.5%, which is still way above average. But that's if all these things, all these dots on here we've put, that's if all these things kind of are baked into the scenario that we end up losing about a percentage of GDP because of the vaccine mutating, having a new wave, which we might be seeing right now. It's in the news right now, right? Vaccines becoming ineffective, people getting the virus and, hey, I got vaccinated. I actually have a couple of friends who had that happen. The Fed tightened sooner than expected, very possible. Unemployment deteriorates, meaning that, either companies start laying people off again, or we just can't get that unemployment rate any lower than it is right now. Consumption, the consumption recovery stagnates, basically, that people stop spending money. So that stops fueling economic growth. And of course, always a possibility. In fact, it happens historically about once a year, is a stock market correction. Nobody enjoys it, kind of like turbulence when you're on an airplane. I don't think anybody enjoys that, but it's kind of part of the ride. So thinking optimistically, though, what if that bad stuff doesn't happen? Their best case from the conference board said 7.4%. That means that COVID cases continue to fall, that social distancing ends, that 2.3 trillion infrastructure plan passes. Now, again, we're not getting into politics. This is just saying that there's a bunch of money that gets kind of thrown out there and goes into the economy. The economic effects of the plan felt by fourth quarter of 2021. Labor market gains accelerate, so that could end up being an improvement, and then spending improves. And what we're talking about is consumer spending. That's us buying more iPhones and driving and getting on planes, all that stuff. That's just us spending money. And the reason why we always hammer on that too, and why you always hear the consumer confidence numbers and things, is because 70% of our economy is consumer spending. Most of our economic growth is driven, or recessions either way, is driven by consumers either spending their money or not. So that's really important to be thinking about all of these things, that these being positives. In other words, they're saying best case 7.4%. Obviously, these are some of the most talented economists in the world, and they don't even know. They're guessing, right? But this is kind of based off of their models of, anywhere between 5.5% to 7.5% is kind of what we're seeing right now. So what are the risks? What could screw all this up? In other words, we always like to talk about that because, I remember during our forecast presentation in 2020, this is before anybody even knew COVID was a thing. We were talking about the fact that our economy was in the longest expansion it had ever had. In other words, the longest period of time without a recession breaking it up in history, in American history. So, we always talk about what could screw things up. I'm not sure if, COVID was one of the things on our list, right, of things that could happen. Bottom line is nobody knows. And oftentimes it is something kind of out of left field that nobody expected. So, a number of things that are kind of on the radar right now that we kind of know about is that U.S.-China technology decoupling. Certainly that relationship has and will continue to be rocky over the years. But the bottom line is we depend on each other pretty heavily. So I oftentimes get comments about that from clients, and maybe we should just stop working with them and so forth. That's not quite so easy. You're talking about the world's number one and number two economies. They do an awful lot of our manufacturing still. That would take a lot of years, to completely decouple that stuff. But there are, concerns certainly with, some social issues over there, as well as what they're doing with our data, what they're doing with our technology. So Chinese aggression toward Taiwan, that's a big deal. If the Chinese follow through on what they say that they're going to do, and they end up taking over Taiwan violently, taking over Taiwan, that would be a really big deal. That would be a massive interruption in supply chains. Taiwan is actually the number one manufacturer of semiconductors in the world. So that would be a really big deal, and not welcome. Obviously, there would be some big political stuff going on there too, with other countries and how they're getting involved. And do we help Taiwan? Do we not? All that stuff. So that would be really a lot of volatility that could be created. Crowding on the Polar Silk Road, that's the shipping lanes, largely controlled by Russia, that like it or not, the polar ice caps have loosened up, and there's a lot of shipping traffic that can go through there now. Major cyber attacks, we've seen some of that this year, so that's always a risk. In fact, what was it last week? We had, I don't know that it was a cyber attack necessarily, but there were a huge number of websites that were down, major websites like Fidelity, for example, that were down for a period of time where people didn't have access to big parts of their technology. So just it goes to show how much we rely on that stuff. And then again, we talked about before, vaccine availability in emerging countries. For the most part, emerging countries have not had a lot of availability of the vaccine. So the virus is not going away anytime soon. It's something that we're going to be living with for years and years. And certainly in some of these other countries, they are disproportionately affected by the fact that people can't travel. And so many of those economies are driven by tourism, ecotourism, and people aren't showing up simply because they don't have the virus under control, and a lot of restrictions on people traveling to begin with at this point. So a lot to be said about that, but there are some risks out there, certainly on the geopolitical front. Growth can be affected by debt too. That's a concern. It definitely is a concern. And in fact, really up until the last few years, the conventional wisdom was that basically once an economy, any economy in the world, went over 85% debt to GDP, that level of debt would actually start to hamper their growth. It would really start to slow things down. And we may not be seeing that quite yet, but it could be something that we see in the future, that our growth rate in the US could be lower because of the debt levels that we've taken on. Again, not making a political statement. It's just the reality that we're borrowing a lot of money, and there are different theories out there economically. There's modern monetary theory, which basically says that you can basically borrow and print as much money as you want to and spend as much money as you want, and there are no consequences. So I don't subscribe to that. I think that sounds pretty risky, and it's not something we've ever tried before. So not sure that we want to now, but that is kind of the going narrative as far as why we're doing what we're doing right now, is that there really is no consequence to the borrowing to begin with. So why not do it? But we are at levels that we've never seen before. I shouldn't say never. Back to World War II, we did borrow at these levels to fund the war, but then it came way down after that. So we'll see what ends up happening. We certainly hope that it doesn't end up causing major problems, but that remains to be seen. So ultimately, we like technology. We like to look into the future and think about all these different things. urban airports for drones and flying taxis. That's a reality. They're testing these things right now, and they think there's actually a huge market there will be for rooftop heliports, basically, for people that are being transported around. You'll be able to call it up just like an Uber. In other words, if you're in New York City and you're trying to get out to LaGuardia, now you'll be able to put it in on your Uber app, and one will show up and you get whisked away to the airport. So at the beginning, of course, it's kind of like space travel. Here recently, Richard Branson, Jeff Bezos, both I think were the first two kind of notable billionaires that ended up doing the kind of civilian space travel. They were the test pilots effectively with their crews. That's going to be a thing. 250,000, I think, something like that is the cost right now if somebody wants to go do what they did in the future. So that's a new industry, but that price will come way down, of course, over time. So stuff that we've never even imagined before, in other words, will be possibilities. Of course, data privacy protection, that's super important and one that we're very focused on. We just did a cybersecurity webinar here recently. Companies are going to have to spend a lot more money, and we are too, but spend a lot more money to make sure that their information is safe. Skill building robots. Recently I read an article about some of these that there are these little robots that can interact with your little kid, and it seems kind of weird, right? It should be humans doing that, but it's kind of interesting to look at what they'll be able to do and how they'll be able to actually help kind of teach them and interact with them and kind of guide them in their learning process. And then, of course, one of the big things that we've been talking about over the years has been electric cars. Many of you have electric or have hybrids. And one of the big obstacles in the past to having an all electric car is that there just aren't a lot of places. Say if you're driving to Minnesota from Colorado, there's not a lot of charging stations. You have to be really strategic about that, or you're going to end up with a problem. So they're experimenting. There's an Israeli company right now that is experimenting with the lithium-ion batteries that actually can do a full charge in 5 minutes. So ultimately, we are going to get to that point where you can get a full charge in about the amount of time that it would take you to fill up your gas tank. Definitely that's the direction things are headed. It's not going to happen overnight, but again, technology really ends up being a huge driver of growth going forward, just like it has in the past. And then finally, self-healing building materials. And really, you think about what happened down in Florida, horrible, tragedy with the condo building that ended up collapsing down there. But you think about the self-healing building materials, it could be something that would end up remedying that with, how things are constructed in the future. In other words, it'll allow things to be much safer and last a lot longer. So ultimately, what are the industry professionals saying? We always like to end with some quotes. First one here, we experienced the equivalent of 5 years of digital growth in 8 weeks of time. In that sense, we jumped from 2020 to 2025. Again, blessings of COVID. There are a lot of terrible things that happened because of COVID, but some of the blessings of COVID is that we've really advanced in many ways as far as how companies operate, productivity. It's really pushed us into the future because we were forced to change. Businesses were forced to change. Consumers, employees, we were all forced to change very, very quickly. Those changes would have come to pass over time, but it would have been much more over a lot more years, right? Until we would have seen the way things were, how we're interacting today. Ultimately, it's important to know that markets are forward-looking. Some concern right now, if we're at peak GDP or if we've already reached peak GDP, what does that mean for earnings? Is the market already at an all-time high right now? In other words, if it is, and it's already baking in all these good numbers, then we need a lot more good news. We need a lot more good information, good earnings, increasing earnings to justify higher prices. So being that we're at higher prices right now, it does make us more vulnerable to declines, to corrections. Every day I see, and Mohammed Al-Arian from Allianz, I always like to hear what he has to say. Every day I see evidence of inflation not being transitory, back to Jeremy's comment, and I have concern that the Fed is falling behind and that it may have to play catch up. And this is what happened in the 70s. We hope that's not the case, but history makes you very uncomfortable if you end up in a world in which the Fed has to play catch up. And that's exactly what they did, caused a really nasty recession in the early 80s, but it did solve the problem. It did kill inflation, killed the economy temporarily. And then, hey, we had a good couple decades there, the 80s and the 90s. And those were in mixed political situations too. It wasn't like Republicans were all in charge or Democrats were all in charge. You had mixed administrations going through those 2 decades and things worked out just fine. But that doesn't mean that there won't be some pain if this is not transitory and inflation continues at this pace. There could be some pain involved in the future. So just be aware of that. But ultimately, Megan Shu from Wilmington Trust, she said over the next 12 months, they actually think that stocks will continue to outpacing bonds, any other defensive assets, but certainly with lower growth rates than we've seen. We think that as well. We don't think that we're going to continue at the same growth rates we've seen in the stock market over the last 12 plus months. Obviously, we enjoyed the party while it lasted, but we don't think we're going to continue to see those growth rates. We still see equity as looking better than fixed income assets over the long run. Of course, you always want to stay diversified, but ultimately, we think this recovery is going to continue. It still has some legs, in other words, to go a bit further, even if there is a correction or two thrown into the mix. That's just kind of normal. But ultimately, the recovery should continue. Ultimately, there's a lot of data we've gone through here, and our job really, as much as it might not seem that way when we talked about all this stuff, making the complex simple. We try to take all these ideas and all the information that's out there and try to simplify it for your financial life. So when you look at this page, we created this just to give you an idea of what do you guys actually do? What's your job at Keystone Financial Services? And I can tell you one thing that really differentiates us is that far left-hand column is what most financial advisors do. And that's all they do. They look at your investments, they manage your investments. They can do that. And that's important. It's not to minimize that at all, because your investments are very important and having thoughtful plans. But there's so much more to your financial life: estate planning, taxes, employee benefits, Social Security, Medicare, all those different things as you go throughout your life. That's our job, is to walk hand in hand with you and really help guide you, because we really are in a position to be able to be that fiduciary to work in your best interest. So, and also coordinating with any other advisors you've got, with your family members. Our job really, from the time that you work with us, is to kind of work with you forever, really, and until you pass away. I know that sounds a little morbid, but we all will pass away someday. So our job is to be there for your family as well. It's not just you, it's also for your family, and making sure that they're taken care of and that they know what your plans were to begin with. So with that in mind, we've got a great team. We've got 8 of us right now. And, certainly at our growth rate that we've got right now, we will continue to add team members, simply because our job is to serve you and to add value and just give you an amazing financial planning experience that you're not going to get anyplace else. Really, we want to be the antidote to kind of the financial industry that really maybe is not acting in people's best interest. They're not fiduciaries, and we want to be that fiduciary in your life, so you really know that you've got somebody that you can trust and it's really working for you. So with that in mind, I know we covered a lot today. There's a few quick disclosures here at the end that we need to show you, a lot of footnotes and things as far as our sources, but I'm going to go back to our happy faces. And with that, Jeremy, what questions do we have that didn't get answered before?
We got one that just came in talking about, government keeping printing money, businesses finding difficulty in finding help. Given inflation is here and maybe here for a while, what are we specifically doing to hedge against it, as far as investments go?
Yeah, it's a good question. Historically, the best inflation hedges long term. Now, short term, day to day, we're not talking about, hey, the market's volatile, can we lose money in stocks, other assets day to day? Absolutely. But historically, the best inflation hedges have been stocks, equities in general, stocks, real estate, commodities. Those have been pretty reliable inflation hedges over time, simply because they have the ability to grow faster than inflation. That doesn't mean that they will at all times. Certainly in the late 70s, early 80s, stock market returns were not outpacing inflation. That's, again, the danger of getting into a hyperinflation situation, is you've got inflation going up faster than growth. So those are the asset classes that tend to do well. Does that mean you should throw fixed income and cash assets out the window and not hold any money there? Well, it depends on your situation, but generally not. Most people do want some buffer in their portfolio for that time when things really do crash, right? The only thing that really went up in value last March of 2020, when everything else was dropping, was treasuries. That was the one safe haven. Again, not anything exciting. You're not going to make a lot of money there. It's just not something that's going to give you a big boost in your returns. It probably will not outpace inflation over time, but it is there for safety. So for those of you who have hold a fixed income in your portfolios, there are reasons for that. We've talked about that with you as far as what risk level you're comfortable with, but sometimes clients are reassessing that as well. And if they had a very low risk posture before, and they're seeing kind of the effects of inflation, and that they're really not going to be able to outpace with how conservative they are, that's a trade-off. And some people are making those moves and just deciding that I'm okay with a little bit more growth and risk in the portfolio. So ultimately, that's a thing. Again, a lot of solutions end up getting kind of taken care of by technology. If unemployment is persistently high, industries that they'll figure out ways around it. They'll automate it. They'll use more technology, robotics. Some of the things that we kind of hit before. That may end up being the solution for a lot of these employers, is that they just increasingly move to technology to kind of fill those gaps where they used to use employees.
Yeah, absolutely. And just kind of tack on to, I don't think there's ever going to be a time where we completely abandon bonds. Obviously with the interest rates where they are, they're not the super best looking thing right now, especially when we're talking about inflation being where it's at. But yeah, there's other things that we do invest in, and then we'll always maintain a specific amount of bonds and diversified, types of bonds as well inside portfolios, just because it's part of a diversified portfolio, right? It's part of asset allocation. But yeah, overall, definitely keeping ideas on our eyes on inflation and making adjustments as needed.
Yeah, and we're continually watching that stuff too. Kind of back to that question, we're continually watching that ourselves, and we pay attention to a lot of research from third parties, from our custodian partners, Fidelity, TD Ameritrade, a number of others, BlackRock. So a lot of experts that we're paying attention to as well, so we can thoughtfully allocate your portfolio. So I know that you've got some experienced hands here, but also ones that are not, we're not in a bubble. In other words, we're definitely paying attention to what a lot of these experts are saying and how they're positioning portfolios.
Yep. And as of now, that is it. We do have a couple more minutes, I think. So if you do have any final questions,
Yeah.
You can feel free to put them into that Q&A section.
Yeah.
Otherwise, if you have something specific to your specific portfolio or life in general, you can always feel free to email us as well. It's jeremy@keystonefinancial.com and josh@keystonefinancial.com. And we can handle those as well.
Yeah, absolutely. Yeah. And it's an honor to be working with all of you, and certainly for you giving up your time today. I know as some of you pop off here, you've got other work commitments and things like that. But yeah, I definitely want you to know that we keep our door open. We want to be very available to you when you need help. And also, again, any coworkers, family members, really that could use our assistance. So yeah, this is fun for us. Jeremy and I are passionate about what we do, and our whole team is as well. But Jeremy and I being on the call here today, we're really passionate about what we do, because not only do we like it, we like money, and we, the technology, everything that we're interacting with, but we really like working with people. We like helping people. We like building a relationship with you. And it's kind of fun because people's lives change every day. So even if somehow the economy and the market never changed every day, and of course that'll never happen, but the rules are changing all the time. Your life is changing all the time. And it's just fun for us because we kind of get to show up every day and we don't know what's going to happen. Right. So it's an honor to be able to serve in this capacity for you. And we plan on being here for many years to come, doing this, educating you, and also working with you on an individual basis. So with that in mind, if there's any other questions, stop me, Jeremy. But with that in mind, we will go ahead and stop for today. Remember, this will be available on our YouTube channel shortly. Hopefully by the end of the day, it'll be out on our YouTube channel. You can get to that link just by going to keystonefinancial.com. And then all of our social channel links are on the upper right-hand corner of the page. Otherwise, thank you so much. Thanks for taking the time to be with us today, and God bless.
Yeah,
Take care.
Thank you all. Take care.